Did you know the simplest path to wealth and the way millionaires quietly build fortunes is also the most boring? It's based on the magic of the S&P 500. I'm going to go out on a limb and say you've probably always assumed investing in the stock market was complicated or even confusing, but it really doesn't have to be. It seems like every day social media is buzzing about meme stocks, crypto hype, and get rich quick schemes. Meanwhile, the wealthiest people quietly use one of the most reliable forces in finance. And today, I'm going to answer some frequently asked questions about investing in the S&P 500. Like, what is the S&P 500? How can I use the S&P 500 ETFs to build wealth? If I invest in the S&P 500 today, what strategy can I use to become a millionaire? If you've ever asked or researched these questions, or I just made you curious about the answers, stick around until the end because I'm going to show you a real blueprint to turn $100 into a million, the boring way. So grab your snacks and get ready to take notes. Let's get into it. Before we get started, welcome back to my channel. If you're new here, hey, I'm Crystal, former corporate finance girly turned entrepreneur and personal finance educator. I have this not so crazy idea that anyone, no matter who you are or where you come from, can master financial literacy and build generational wealth. And I'm here to share some strategies on how to do just that. So stick around and become a part of my community if you're ready to get wild about wealth. All right. Let's start with the basics. What is the S&P 500? The Standard & Poor's 500, better known as the S&P 500, is a stock market index that tracks the 500 largest publicly traded companies listed on the US stock exchange, primarily in terms of market capitalization. While other factors contribute to how these companies are included in the index, the companies listed in the S&P 500 are those that generate the highest annual revenue, like Apple, Microsoft, Amazon, Nike, and hundreds more. Think of this like a playlist that has the top 500 performing songs in the US. Instead of betting on one song to blow up, you're listening to a mix of all the biggest hits. Some songs will flop, some will top the charts, but overall, the playlist is always stacked with winners. That's essentially how the S&P 500 works. You don't rely on one company, you own a little piece of 500 of the biggest hits in the US economy. This index has been one of the most trusted wealth building tools for decades because it drives this kind of diversification. Here's why people care about the S&P 500 today. This index makes up about 80% of the US stock market's value and is considered to be one of the most reliable indicators of how the US stocks are performing. When the S&P 500 goes up or down, people use it as a thermometer for the entire economy. The S&P 500 has historically delivered an annual average return of about 8 to 12% over a 30-year period. While performance can fluctuate year after year, the trend has been consistently up. Of course, it's not perfect, but if you want to get an idea of how the US stock market is doing, you look at the S&P 500. So tell me, how much did you know about the S&P 500 before today? Let me know in the comments below. Now that you have a pretty good idea of what it is, let's talk about some ways you can invest in the S&P 500 today. Though you can't invest directly into it, you can invest in funds that track or mimic the S&P 500 performance. These funds can include ETFs, mutual funds, and index funds. Let's talk a little bit about the difference between each type of fund to give you a better idea of your options, starting with ETFs. ETFs, or exchange traded funds, contain groups of investments, primarily stocks and bonds, but they're tailored around specific strategies or themes. ETF share prices fluctuate throughout the day and can be purchased at any time during the regular trading day. Here's a quick definition for you. With ETFs, you have the option to own a little slice of everything instead of betting on just one company. If one company has a bad year, the others balance it out. Also, ETFs can be a cheaper option than mutual funds. Speaking of mutual funds, these are similar to ETFs but have a few key differences. Mutual funds gather money from investors to purchase a diversified portfolio of stocks, bonds, and other securities. And they're bought and sold once per day at the market's closing price. Here's another quick definition for you. Like ETFs, mutual funds generate returns through capital gains, meaning the value of the investments within the mutual fund increase. Earnings can also come from dividends and interest payments or selling shares for profit. Index funds are types of ETFs or mutual funds that mimic the makeup of different indexes, like the S&P 500, in order to copy their performance. They provide broad market exposure, and this is what you want in order to achieve diversification across your entire portfolio. These three types of funds are the peak of boring investing for two big reasons. The first is instant diversification. If one company has a bad year, it's balanced out by the other companies in the fund. This massively reduces your risk compared to putting all of your eggs in one basket, like you would have if you only purchased individual stocks. Second, it's completely passive income. You don't really have to do anything. You simply pick your funds, buy them, and hold on for the ride. It's the ultimate set it and forget it strategy. If you've ever thought investing in the stock market only means picking individual stocks, I can assure you, you have significantly more options that are less risky and easier to choose from. You can start investing in the S&P 500 today by simply investing in one of these funds. My personal favorite is ETFs because they tend to have lower fees and offer a broad range of market exposure. If you've ever thought investing meant picking risky stocks, hit that like button because now you know the boring way is way better. Okay, it's time for some real fun. So go refresh your snacks and flip the page in that notebook because this is the real magic, the $1,000,000 blueprint, step by step. Step one, open a brokerage account at the financial institution of your choosing. There are several options out there like Fidelity, Vanguard, Schwab, just to name a few. You could also check out apps like Acorns if you're just getting started. Acorns makes investing simple and straightforward. I'll provide a link below in the description for quick and easy sign up. Step two, deposit your first $100 and purchase shares of your chosen investment. As discussed earlier in this video, low-cost ETFs that mirror the S&P 500 are a solid investment option. It creates diversity and offers easy, set it and forget it solutions to investing. Step three, contribute consistently. Making regular contributions helps create the habit of investing and also helps smooth out the bumps from market ups and downs with an investment strategy called dollar cost averaging. Dollar cost averaging is a strategy where you invest fixed amounts of money on a regular schedule, like weekly or monthly, no matter what the market is doing. In some weeks or months, prices will be high, which means you'll buy fewer shares. But when prices are lower, you'll be able to buy more shares with that same investment. Over time, this averages out the price you pay and reduces your risk of bad timing. To make this step seamless and easy, set up an automatic transfer from your bank account into your brokerage account to add your contributions. Remember, set it and forget it? Check out this video right here for more strategies on automating your finances. And finally, step four, be patient. Don't panic when the market dips and sell out of all of your investments. That's how you lock in losses. The market historically always comes back up after a downturn. So you'll want to keep your money invested so you don't miss the gains on the way back up. And don't chase the hype when the market is soaring. Just stay the course and follow your plan. Now let me explain with some real numbers how this boring method can turn you into a millionaire. We'll use a conservative average of 8% a year to be safe and to account for fees. If you start with a $100 balance in your brokerage account and add $500 every month, and the market delivers 8% average return, you'll cross the $100,000 mark in about 11 years. Just think about that for a second. In 11 years, you'd have a six-figure portfolio. But out of that $100,000, you would have put in about $66,000 yourself. That means the other 40 would have been generated entirely from market growth. Your money would have worked almost as hard as you did. If you continue to invest at the same rate, you could hit $1 million in just under 35 years. So let's talk about this. At first glance, $500 per month may seem like a huge hurdle to jump, but consider the 50-30-20 method of budgeting, which I go into in this video here. In that method, you would be targeting about 10% of your income to put towards investing. If you follow this method, $500 per month is 10% of the $60,000 annual salary. The median annual salary in the US is about $62,000, so not far from that target. Of course, this $500 per month number is a reference point. You may be able to contribute more, or you may need to cut the contribution in half to $250 a month. Even at $250 a month, you could still generate over $500,000 within that same 35 years. And sure, lower monthly investments amounts take you longer to reach that $1 million account balance, but the sooner you start investing, the more time you'll have in the market. And time literally equals money. Now, you want to know the hard part? It's not setting up the account, it's not calculating how much to put in, and it's certainly not choosing what to invest in. It's you. This strategy is simple, but that doesn't mean it's easy. Yes, the math is solid, but human psychology is a mess. The single biggest threat to the boring method succeeding is you. Your own brain will try to sabotage you every chance it gets. When the market is flying high, you'll be tempted to get greedy. You'll hear stories of people making a fortune overnight and think, "Ugh, maybe I should pull my money out of this boring fund and chase the hot new stock." That's FOMO, the fear of missing out, and it can be a real wealth killer. And when the market is crashing, you'll be tempted to panic. Your portfolio will be in the red, and every news anchor will be talking about doom and gloom. Your gut instinct will scream at you to sell everything to stop the bleeding. That's panic selling. And it's how you guarantee your losses and miss out on the market recovery that has historically always followed. You have to trust the process and understand that your focus is on the long game. You also have to accept the fact that on the path to $1 million, there will be years when your portfolio may go down. That's normal, it's expected. Your only job is to keep investing that same $500 every single month, no matter what. When the market is down, think of it as buying investments on sale. Once you're committed, there are very few decisions to make. You don't have to watch the market every day. You don't have to read the scary financial news. You just set up the automatic monthly investment and go on with your life. The freedom that comes from that is worth more than any risky short-term gain. Building wealth doesn't have to be complicated or filled with high-risk investments, and it certainly doesn't have to be all that exciting. The truth is that for most of us, the real path to financial freedom is with consistency, patience, and a healthy dose of boredom. This path is open to everyone, and it doesn't matter if you're starting with $100 or $1,000. The principles are exactly the same. Start early, forget the hype, and ignore the noise, and let time become your most powerful ally. As always, thank you for watching, and please remember to like, subscribe, and share this content with someone who's ready to get wild about wealth. Take care.